So far, we have done our feature engineering, trained our model for stock price direction prediction, and analyzed the performance metrics of the model. Unfortunately, performance metrics show that the model does not perform well. What else can we do to improve the model? Fret not, because there are some techniques we can use to try and improve model performance. But before we go into techniques to try and improve performance, previously, I calculated the estimated earnings based on the number of correctly predicted directions, and it resulted in greater than $10,000 losses. This time, I will try to calculate the cumulative earnings in a more realistic way. I will recreate a data frame using data for the first half of 2026 for calculation. Then, since I am trying to trade credit spreads, I will compute the profits and losses based on whether the closing price is above or below the sell leg strike price. For example, if the previous day's closing index price was 7,470 and today it closed down at 7,455, the model predicted that it would close up instead. But if the bull put spread I bought was to sell at 7,450 and buy at 7,440, I would still make money because the short put strike price is below the closing price. Thus, using the same amount of 50 for profit and 400 for losses, I code a function to compute the cumulative earnings for the model prediction. I will code the short entry strike price based on a distance of 20 away from the opening price for the day. Initially, I was thinking of using the daily average true range as a gap, but decided on using a fixed distance of 20 instead because the daily average true range is quite wide at around 80 on average. And in the real world, the profit for a distance of 80 is much less than $50. Thus, I used 20 instead to reflect a more realistic profit margin. Then, I will compare the entry price against the closing price to compute the P&L. Unfortunately, the results are the same as before. Plotting the cumulative earnings plot, we see that following the predictions of the model would result in a cumulative net loss of more than $12,000. However, calculating the P&L this way can also make for a type of metric to measure and compare different models as well. Checking the breakdown of trade P&L by the credit spread strategies, we can see that a bear call spread has a lesser loss compared to a bull put spread. This seems to suggest that there is greater predictability or better profits when predicting the stock index price closing downwards. So far, we see that the base model is not able to turn in a profit. But what if we tune some of the model parameters? Will we see an improvement in performance? To that end, we can do a simple hyperparameter tuning with RandomizedSearchCV. We will run it and output the best possible selected hyperparameters based on our selection criteria. Once we have the best parameters, we will fit the model and use it to predict the test data. Unfortunately, it seems that the tuned model performance is worse than the baseline model. It has a lower accuracy score of 50.41% compared to 53.72%, and its metrics are worse off across the board. We can also apply the same function to calculate the cumulative P&L, and we can see that losses are somewhat similar to the baseline model. A noticeable difference here would be in the breakdown of P&L by credit spread strategies, where we see that the losses between the two strategies are closer compared to the baseline model. We have tried hyperparameter tuning and the model performance does not improve. Is there anything else we can do to improve performance? Well, there is still one trick left up my sleeve, and that is calibrating the model with a sigmoid method, otherwise known as Platt scaling. Say the baseline model outputs a predicted probability of 0.30, which we would interpret as the model predicts a 30% probability of the event occurring. But does it really happen 30% of the time in reality? To find out, we can calibrate the model output to real-world occurrence by running a logistic regression model on the model output using the test dataset, and map the real-world probability to the calibrated model probability by plotting them on y and x-axis. If the model's predicted probability is the same as the real-world's probability, we would see the plotted line to be the 45 degrees line diagonal to the origin. Now that we have a better sense of what the calibration curve or Platt scaling is, we can proceed with the code. We will run the calibration classifier CV function on the model and fit the training data. Next, We will generate the calibration curve coordinates and plot them out for visualization. The calibration curve tells a story. Looking at the red line, which is the original model results, we can see that the model is not as confident in its prediction for lower probabilities less than 50%, and the model is overconfident in its prediction for probabilities greater than 50%. The calibrated model score is only slightly better, but it becomes flatter, highlighting the low confidence in lower probability predictions and overconfidence in higher probability predictions. Essentially, the model is not a good discriminator and unable to separate the labels well. This is in line with what we have discovered previously. Up till now, what we have done so far is defining two distinct outcomes only, whether the stock price index closes up or down. However, if we increase the number of labeled outcomes by the percentage of price movement, will the model be able to perform better? To start, let's first take a look at the distribution of percentage price movement from 2020 to 2025. Looking at the summary statistics, it is quite interesting to see a huge variability in movement, with the largest drop being -13% and the largest increase being approximately 9%. The median move is approximately 0.1% increase, with a standard deviation of 1.3%. We can't infer much from here, so let's visualize it via a histogram. Since the range is quite wide, to get a better sense of the distribution, I will clip the ends at 2.5% each, and we can see it somewhat resembles a normal distribution, as approximately 45% of the percent price change are within -0.005% and 0.005%. We will set 4 labels, with ranges as below -0.005%, within -0.005% to 0%, 0% to 0.005%, and greater than 0.005%. We can check the proportion of labels, and it is somewhat evenly distributed, though there is a slightly higher proportion of percent price returns greater than 0.005%. This would still be considered a balanced dataset. As such, we can proceed to create a dataset based on this label split and rerun the XGBoost model on this dataset. Did the model perform better on this new multi-label dataset? Unfortunately, the performance is now worse than before. Previously, we achieved an accuracy of 54% on binary labels. Now the accuracy has actually dropped to 28%. The precision across all the labels are worse off compared to the baseline model as well. Looking at a histogram to visualize the correct predictions based on the predicted probability, we see that the correct predictions are throughout the range of predicted probabilities, which confirms the poor performance of the model. Referring to another histogram only for correctly predicted labels, we can see that the majority of them are correct predictions for moves greater than 0.005%. The model has performed poorly based on metrics. Now what about its P&L? We can run a function and compute its cumulative earnings. As you probably have guessed, the performance is worse off as well. But wait, previously, there were only 2 labels, and so we take reference with respect to the opening price to compute entry price. Now that we have 4 labels, is it still fair that we only use the same opening price to compute? Well, we can try to compute based on 4 different entry prices by incorporating the threshold of 0.005% of change in price movement. After we have included it, we can see that the P&L actually improved, although overall, it is still a net loss. Next, we can also perform a similar simple hyperparameter tuning on the model for multi-labels and observe its performance. Same as before, hyperparameter tuning did not improve the performance, and overall, the tuned model performance is worse off compared to the original model, and you can see the cumulative earnings chart here as well. Apart from hyperparameter tuning, we can do the same calibration exercise for multi-labeled data as well. This time, we will have 8 charts, where the first row represents the raw XGBoost model probabilities, and the second row represents the calibrated probabilities. The columns are arranged in order of the predicted class labels. At a glance, we can see that it is a mess. Across the board, the model is overconfident in its own predicted probabilities, as seen by the blue lines below the diagonal lines. Even for the calibrated probabilities, there doesn't seem to be that much improvement, and they follow the shape of the uncalibrated probability curve. Perhaps if we provide for more data points, the calibration curve performance would improve, but for now, the curve shows that the model is generally unable to distinguish between the different labels well enough. It is a shame that hyperparameter tuning and calibration did not improve the model performance. Perhaps my feature engineering is not good enough, or I am using the wrong model. These are things that I will look at and analyze further. But does this mean that I am unable to use the model to make money? Well, I think it depends. Yes, if you are solely relying on the model outputs, and no if you are using it together with your own human assessment. Since the start of July 2026, I have actually been using the model to live trade with my own technical analysis and judgment, and I place trades accordingly. If there is alignment, I will place a trade in that direction, but if there isn't, I will place trades using my own judgment. So far in the past 3.5 weeks that I have traded, it has been profitable for me, except for a single day that has a huge loss due to my own tiredness. That said, I will still continue to try to improve machine learning model performance or try out other methods to continue on the path towards my dream of an automated trading system. As usual, I have linked the code in the description box for those who are interested in trying it out, but I have left out the code for the model features and trading indicators. Do you have any thoughts on it? Feel free to comment in the comment box down below. If you liked this video and would like to see more content of this nature, please be sure to like and subscribe as well. Thanks for watching, and until next time.